Hi everybody, Andrew Hewison here, Managing Director of Hewison Private Wealth. I and the advisors at Hewison's always love an opportunity to drive home one of our favourite key messages to our clients. And that is that diversification and a disciplined rebalance approach are vital keys to long-term investment success. Now, on the front page of the September 2 weekend Australian Financial Review, there was a sensationalised heading that said, after the crash 1987 to 2017, lessons from 30 years of investing. The article followed up with a great graphic on page 31, which detailed the 30-year performance of each asset class over the period. Not surprisingly, US shares came in first, delivering 9.5% per annum, of course supported by the boom following the GFC. Aussie bonds rolled in second, delivering 8.5% per annum, and Aussie shares third with 8.4%. The article didn't provide data on unlisted commercial or residential property. However, a report published by the ASX, and I'll link that article below, showed that residential property had delivered 10.5% per annum over 20 years to December 2015. Add a further 10 years to this at the beginning of the period, and it's fair to say it's done pretty similar to the Australian share market. Now, this may surprise some people given the property's recent boom in Melbourne and Sydney in particular over the last 10 years, but these are the figures. The takeout here when evaluating the return graph is that each asset class did not go up and down during the same periods of time. So how do investors know when to be invested and in what? Well, it's easy, they don't. Not even an investor is as astute as Warren Buffett knows when and where to invest his money at a particular time. It still amazes us, but doesn't surprise us, how many investors, even in the high net worth space, are willing to either discount particular asset classes altogether or be advised by God knows who to switch from one asset class to another. As we've been shown over and over again, past returns are no indicator of future performance. I'm going to be honest here, many financial advisors out there simply don't have the knowledge or expertise to advise on the many different asset classes that are available. Cash and fixed interest, not just term deposits, domestic shares and international, and of course, the many various forms of property. Added to this, unsuspecting investors don't know what to look for either, and often take the advice they receive as gospel. Now, getting back to the chart, which also details major events coinciding with market corrections, what it shows is that sometimes the best investment opportunities are following major global catastrophes when investors couldn't think of anything worse than to reinvest. We refer to this simply as investing with your head and not your heart. Timing markets is also destined to fail. The two great examples recently of this, when investors expected markets to fall, came after the Brexit vote and the Trump presidential victory. Following both events, markets have continued to rise. In our 30-year experience, remaining true to your investment strategy and long-term asset allocation, timely rebalancing back to your asset allocation, including when your heart may not be in it, and taking a long-term view on your investments will always win out in the end. Thank you very much for your time, and see you next time.